overarching view is that the market is slightly ahead of its long-term valuation metrics, few standard deviation above certain metrics that people choose to look at, much more expensive. India, much more expensive compared to the world. But select markets which are doing well are anyways looking a bit more expensive in light of the fact that we are in a world where interest rates are moving up, wherein there is quantitative tightening and geopolitical stress. So are you fully invested currently? And if so, how do you align your thought to stay fully invested in light of all of these uncertainties that we have currently?
Sure. So, taking the last one first, we always are fully invested, except for the period when we are selling something to buy something else. And, in our system, you need to raise cash before you can deploy. Can't happen simultaneously. So on a day or two, you may see some cash, but otherwise, no, we stay fully invested. One big reason for taking cash calls, to my mind, is to dampen the portfolio. A high beta portfolio, if you take a cash call on the way down, it will dampen performance. Dampen performance meaning it won't fall as much as the fall in the market, and that helps the fund managers. If you look at our portfolios are low beta historically. If you buy steady, strongly growing businesses with less variation in profits, that element which causes volatility itself is less there, and hence in not so good periods, we tend to do mostly much better. So over last 11, 12 years, there have been just 3 instances when we may have fallen more than the market in a large market fall. So our need to raise cash to dampen the move down is also not there. And I tend to see cash as a source of risk as well. Raising cash, there has to be a thesis behind it. That thesis does not change at the bottom of the market. Okay, and most managers, most individuals, most investors who raise cash would end up deploying cash at levels higher than where they have, if not in one instance, but over multiple instances, almost definitely. And hence, taking cash calls is to be seen as a source of risk. It looks good for a period of time. It almost always hurts performance. Now, coming down to your first bit, geopolitics and all of that, a lot of it is very good for India as a country. So, if there are, let's say one country flexing muscles versus the US, US wants to diversify business to other countries. We are one in the line, we benefit. Okay, if two countries fight with each other, suddenly the make in the country, we always said make in India, but make in the country becomes a global theme. And when somebody then tries to give protection to their own businesses, it is not frowned upon in the manner that it used to be just before COVID. Okay, so that again gives a lot of strength to Indian businesses. And it is not an accident that you see a lot of positivity towards doing capex in the country, because businessmen are seeing profit, they are seeing ability of the government to defend the business, and margin sustaining for longer. So a lot of things happening globally is a huge positive for us. I think it helps that we are also learning to not dabble too much in geopolitics and do business. So if two people fight, theoretically it is good for everybody else who can do more business. And that is what our chaps have really communicated well. And markets are celebrating all of that. In terms of business outlook, in many ways, hence, we are better off than where we had been over last 10 odd years. Okay, if you segment the last 10 plus years into two halves, the first half, you would see margins of corporate India falling. And that was the period when bank bad loans were getting recognized. That was the period when globalization was at its peak and you were having to drop import duties. Chinese competition was so high. You saw decimation of several Indian businesses just because Chinese thought they would want to manufacture it. Now that's changing very, very sharply. Bank loss recognition is behind, bank profits are up. Well, yeah, credit growth did fall in between. Now it is again rising up, and margins are ticking up. Even next of bank margins are ticking up. So there is this change that one is seeing, plus the outlook. After 2003-4, we are looking at capex not being a drag on the economy, but being an engine of growth. Government was always doing it. Private sector has started to do it. Even households have started to buy housing. So all three engines coming together, and that really helps. It's not something which starts and stops quickly. If it happens, it gives some tailwinds to consumption as well. So I think lots to look positive to and be overall positive. So if somebody is a growth investor globally, there are not too many places you can invest into. Large geographies, USA, Russia, Europe, not growing. China slowing down. Japan not growing. Our subcontinent, apart from India, not growing. Middle East growing. Commodity countries still growing because of commodity tailwinds, but very, very shallow, few companies kind of markets. So if you are a global investor also and you want growth, if your philosophy is growth, then choices are limited. So coming down from there to valuations, yes, today because of this, we may be looking at better than others, other emerging markets. My thought is that we are fine basis our historical valuation matrices, such as PE. No point in looking at very long period E's because the makeup of the index itself has changed. If you look at what is there in the index, and we did a slide on that, in 2002-3 kind of a period, the cheap part of the index used to be closer to 40%. Commodities, government kind of stuff. The more expensive part on PE, the high PE part of the market, consumers, insurance, private sector, financials, etc., are retail companies are now close to 50%, and they will sustain there. If that thesis about richness of business and longevity of growth is playing out, it will probably sustain there. So if you look at last 10-year kind of PE averages, we are there. On some periods, we may see a tad lower. On some periods, we may see a tad higher, because this 10-year period actually had a COVID low and another deep dash. So that makes the averages a bit different. But 18 and a half are sustainable numbers 1 year forward. So with index CPS expected to be, I would say, closer to 950, 960 kind of a level in 2024, I think we are at sustainable levels on PE. As far as our own history is concerned,